Welcome, everyone. When we evaluate high growth opportunities, we often focus on the next 3 to 5 years of revenue. However, for most successful enterprises, the vast majority of their intrinsic value lies far beyond that initial forecast period. This is where terminal value, or TV, comes into play. In a standard discounted cash flow analysis, terminal value frequently accounts for 60 to 80% of the total enterprise value. If you don't master this estimation, your entire valuation is built on a shaky foundation. Today, we are going to dive deep into how VCs and professional investors calculate the forever value of a business, ensuring that your investment thesis is backed by rigorous financial logic rather than just optimistic guesswork. We will bridge the gap between short-term projections and the infinite horizon of sustainable growth. At its core, terminal value is the present value of all future cash flows when we assume a business will continue to operate indefinitely. In the world of finance, we cannot project line item expenses for 100 years. The margins of error would be astronomical. Instead, we use the terminal value to capture the value of the company at the point when it reaches a stable, steady state. This is critical for high-growth startups that might be burning cash today but are expected to dominate their market in the long run. By establishing a terminal year, we create a boundary for our detailed modeling while still capturing the long-term wealth creation potential that attracts venture capital and angel partners in the first place. The first primary method is the perpetual growth model, also known as the Gordon growth model. The formula is terminal value equals the final year's free cash flow multiplied by 1 plus the growth rate, all divided by the discount rate minus the growth rate. It sounds complex, but it's the gold standard for mature companies. The key variable here is G, the stable growth rate. For a valuation to be realistic, G must be lower than the overall growth of the economy, typically tied to GDP or inflation. If your G is too high, you are essentially projecting that this single company will eventually become larger than the entire global economy, which is a major red flag for sophisticated investors. While Gordon growth is popular for mature firms, venture capitalists and private equity firms often prefer the exit multiple method. This approach assumes the business is sold to a strategic acquirer or via an IPO at the end of the forecast period. We calculate the terminal value by taking a financial metric, usually EBITDA or revenue, and multiplying it by a factor common in the current market. For example, if a SaaS company is projected to have $50 million in EBITDA in year 5 and the industry exit multiple is 15x, the terminal value is $750 million. This method is highly sensitive to market sentiment, making it vital to use realistic, defensible multiples based on recent comparable transactions. Selecting the long-term growth rate G is more art than science, but it must be grounded in reality. Typically, this rate falls between 2 and 3%, aligning with historical inflation and developed market GDP growth. If you are pitching to an angel partner and you claim a terminal growth rate of 10%, they will likely dismiss your valuation immediately. Why? Because over an infinite timeline, high growth is unsustainable due to competition and market saturation. We must also consider the industry life cycle. A tech company might have a slightly higher G than a manufacturing firm, but even then, gravity eventually pulls all growth rates toward the mean of the global economy. The terminal value we calculate is the value at the end of year 5 or 10. To understand what that is worth to an investor today, we must discount it back using the weighted average cost of capital, or WACC. Because the TV is such a large number, even a half percentage point change in your WACC can swing the valuation by millions of dollars. For high-growth startups, the WACC is often high, 12 to 20%, reflecting the significant risk involved. As an investor, you must scrutinize the discount rate used. A low WACC makes the terminal value look artificially inflated, while a high WACC might hide the true long-term potential of a powerhouse business. Experienced VCs never rely on a single terminal value number. Instead, they use a sensitivity analysis table, often called a football field or heat map. This table shows how the valuation changes based on different combinations of the exit multiple and the discount rate. If your valuation only works when you assume a perfect 20x exit and a low 8% discount rate, your deal is fragile. Professional investors look for robustness, meaning the investment still makes sense even if the exit multiple drops or interest rates rise. By presenting a sensitivity matrix, you demonstrate to partners that you have accounted for market volatility and are not just cherry-picking the best-case scenario. In conclusion, mastering terminal value is about balancing optimism with financial discipline. Whether you use the Gordon growth model or the exit multiple approach, the goal is the same: to provide a credible, defensible estimate of what a company is worth when the dust of the early growth phase settles. For investors, the terminal value is where the exit happens. It is the legacy of the business. By using realistic growth rates, appropriate discount factors, and thorough sensitivity analysis, you can pitch or evaluate opportunities with total confidence. Remember, the value of today is defined by the sustainability of tomorrow. Thank you for joining this deep dive into mastering long-term growth estimation.